I now resume the hearings and hand over to Ms Spender.
Thank you very much. Thank you for your comments to date. You raised, I think, a really interesting challenge that we face right now, in the sense that we have, as you say, full employment, record terms of trade, and a structural deficit, and the opportunities that we have in terms of how we have to address that over longer term. I'm really interested in your thoughts on some of those key structural reforms that you think we should be considering in this space to drive productivity.
It's a good question. It's not really kind of my core area of competence, but I'd note that the Productivity Commission now is doing their 5-yearly review. The last one they did was called Shifting the Dial, and I think it was back in 2017, and it had a lot of very good suggestions about the way we design our cities, the way that public services are provided by the government. So that report had a lot of good ideas. Not all have been implemented. But the list of areas where reform is needed, I think, is long. And I've got a few notes here, but these are points that others have made. That taxation system, the combination of taxes on land, income, consumption, natural resources and savings. Anyone who looks at that doesn't say we've got the optimal system. In fact, they say we're a long way from optimal on most of those areas. So that's an issue for the Parliament that's very difficult. The way we select and price infrastructure, there are improvement opportunities there. The way we train our workers, our people who work in Australia, the accumulation of human capitals, starting at preschool and then going right through to university. The way we regulate the energy system, we probably haven't nailed that. The complexity of the regulatory system and the rewards we establish for innovation. The way we train our people to use data and protect data and to take advantage of data. So these are all areas where Australia has huge opportunities. I think if we put our collective shoulders to the wheel, then we can do this. But it requires both reform from government and businesses. It's not just government to do it. As businesses have to step up in each of these areas as well. So there are plenty of reports that give us good suggestions. As I said to kind of committees previously, the issue isn't knowing what to do. It's actually developing the political and other capability to do it.
Okay. Thank you. Professor Warwick and McKibben has argued that climate change impacts are likely to lead to a more frequent and more severe negative supply shocks. And is that your view? And slightly more broadly, how is the RBA considering how it addresses climate change from a monetary policy point of view?
Yep, thank you. Well, I agree with Professor McKibben's observation that we are going to see more supply shocks because of climate, and we'll have to factor that into our decision making. We're spending a lot of time on climate-related issues, not just because they affect the economy, but also the financial system. The energy transition is a huge opportunity for Australia and could reshape our exports. Coal exports over time will go to zero, and gas will, over time, will be depleted as well. But we have huge opportunities there. So in thinking about the prospects of the country over the next 20 or 30 years, the investments we make in renewable energy are incredibly important. They don't affect kind of monetary policy decisions from month to month, but over the next 20 years they're going to be incredibly important. They're affecting the investment outlook, where the jobs will be, and the prices we pay for a whole bunch of goods and services. So they're really important framing issues for our decisions, but obviously they're not going to affect whether we change interest rates by 25 or 50 basis points next month, but they're really important framing issues. The other set of issues that we're working very closely on are related to the financial sector, and I chair the Council of Financial Regulators. There are two major pieces of work going on there. The first is the climate risk vulnerability assessment, so asking the banks to do these exercises to see how well they're prepared and managing climate risks. The other, which is work that really ASIC is leading, is disclosure. Because the allocation of capital is critically important to solving many of these risks, and for the capital markets to work well, people need information. They need to understand what your risks are, how you manage them, and what the opportunities are. And there's a global effort here to improve the quality and comprehensiveness and consistency of disclosure. ASIC is leading that work, and through the Council of Financial Regulators, we're spending a lot of time, and I think that's really important, because capital markets will help us seize the opportunities we have as a country here, but we need the capital markets to have the information to make the right decisions. So it's not just governments kind of putting in place the right policy framework, it's the disclosure environment guiding the allocation of capital. We're also involved with a group called the Network for the Greening of the Financial System, which is where the central banks around the world have come together to look at these issues in a global context. So we're spending quite a lot of time with that group as well.
Okay, thank you. I want to get to another very difficult issue, which is housing and housing affordability. Obviously one of the biggest impacts of the increasing in interest rates is falling on households, when housing affordability by global measures is extremely low in this country anyway. I'm interested in your perspective on how important increasing housing supply in the long term is important to supporting greater financial stability, affordability in the economy, as well as enabling households to better weather changing monetary policy.
Yeah, but it's a good point, and we've discussed this at kind of previous versions of this committee, because interest rates get the blame for movements in housing prices, and I understand that the decisions that we take drive a lot of the cycle in housing prices. So that's why housing prices are falling now, because we're raising interest rates. So a lot of the cyclical variation comes from the Reserve Bank. But the fact that Australians have to pay high prices for housing isn't anything to do with the Reserve Bank over a long period of time. It's the choices that we've made as a society have given us high housing prices. Because high housing prices come not from the high cost of construction, they come from the high cost of land embedded in each of our dwellings. So why do we have a high cost of land embedded in our dwellings? It's because of the choices we've made. The choices we've made about taxation, the choices we've made about zoning and urban design, the fact that most of us have chosen to live in fantastic cities on the coast, the fact that when we choose to live in these fantastic cities on the coast, we want a block of land. We don't want to live in kind of high density. And we've chosen a society to underinvest in transport. So all those things have either reduced the supply of well-located land, or increased the demand for well-located land. So we have high land prices embedded, which give us high housing prices. And interest rates influence the cycle, but not structurally. We see kind of in country, the US is a good example. Parts of the US, interest rates have been lower than they were here, but housing prices are much lower because as a society, they've made different choices about where they live, the investment in transport and the taxation. So it's the choices we've made as a people that have given us high housing prices, even though the interest rates influence the cycle. But and the central bank can't do anything about that. As an individual, but there's not as a central bank government, I think it would be better if we make different choices to give a lower average level of housing prices. That would give people more opportunity, and people would need to borrow less. I think the other choice we've made of society is to make mortgage finance freely available. Great, dynamic, competitive financial sector is happy to provide mortgage finance. So everything we've done is, if you ask what choices society could make to give high housing prices, we've made them all.
We made them all. Okay.
Not to say good or bad, but that's what we've done.
Yeah. Okay. One of the RBA's mandates is to deliver full employment. With the current rate of unemployment, I think this perspective on what is actually the non-accelerate NAIRU effectively is sort of much more debated than I think in the past. I'd love to understand from your point of view, how are you starting to think about NAIRU, the non-accelerating inflation rate of unemployment, and how do you start to evaluate your future models in relation to that now?
Yeah, it's a it's a good question. It's a hard one as well. 'Cause not so long ago, people were saying, well, if we get the unemployment rate in Australia down to 5, that would be a great outcome. And I had been hopeful that we could do better than that, and I was hopeful we could get it down to 4. I thought, gee, if we could get the unemployment rate to 4, that would be a fantastic outcome. Here we are at 3.5. I'm doubtful that whether we can sustain 3.5, because the feedback we're getting from business through the liaison program at 3.5% unemployment is just way, way too hard to find workers. But you never know. I don't know, Lucy, has your staff been doing kind of modelling and
Yes, we have. I mean, I think one of the challenges, the governor's absolutely right. We've been thinking something in the low 4s. I think I said at the last meeting of the previous version of this committee, something in the high 3s to low 4s was our current best assessment, and we used something at the upper end of that range as the sort of the notional NAIRU in our most recent round of forecasts. Unfortunately, the standard academic models of how to, estimate the NAIRU, because you do have to infer it from data. You can't just it's not there, to be seen directly. Because unfortunately, those models, they look at the pandemic period and they'd tell you that the NAIRU was going up at the moment. Now, I don't believe that for a minute. I do not think that the actual evidence on wages growth tells you that the NAIRU is, back above 5. But, these models, they look at inflation and wages growth and unemployment all together. And, so there's also an assumption, you also have to infer inflation expectations from the various, partial indicators of that. And that, those standard models are very much on the assumption that everything's driven by demand. They don't deal with supply shocks, and they've certainly never seen a lockdown before. And so those models would spit out a much higher number. So one of the active pieces of work that the team are working on is, how do you actually sort of manage a NAIRU estimate when there's been a pandemic and you've had these big supply shocks? So, I mean, we have had to just apply some better judgment, in the most recent forecast rounds, but I think it's an active area of research.
I think, and then I'll come to my final question. I think I'm almost out of time, but it's just more about the lags. You mentioned in your opening remarks that one of the issues that we face is the lags to, the impact of the rate rises, particularly in relation to people who have fixed rates mortgages. How do you account for the potential lags in feeling these changes, and what are some of the lessons we can learn from the past in terms of how those lags have played out that we should bear right now?
Yeah, but the evidence that we have from the past is that when we change interest rates, the maximum effect on economic activity is roughly 18 months to 2 years afterwards, and then it takes a while for that to feed through to inflation. So there's a kind of maybe a 2-year lag before we see the maximum effect of that, and that's understandable because when you think about the transmission mechanisms of monetary policy, one's the exchange rate. So the exchange rate changes, and then it takes time for firms to change their investment and sourcing decisions, and then another is through changes in housing price we've talked about before, and that affects spending, but it takes time for people to do that. And then once people change their spending, then it takes time for firms to adjust their investment plans. So by the time you go through all these layers, they're quite long effects, and we're very conscious of that. So we have to forecast. This is one of the reasons we have to forecast. During the early stages of the pandemic, we said we were going to base our monetary policy on actual inflation, because we'd had a period where we were undershooting the inflation target, and it was, our forecasts had not been that good, and we had to focus very much on actual outcomes. Now that actual outcomes have moved so much, we're moving back into a world where we've got to rely more on our forecasts. And in forecasting, we factor in these 18 months to 2 year lags. The other consideration in kind of setting policy is not just understanding the lags, but think about the level of interest rates. And really in response to Andrew's questions before about, is the level of interest rates roughly expansionary or contractionary or neutral? And so put together the assessment, their level, it's getting close to normal, probably still a bit low, and the lags. So it's difficult because the lags changes through time as well. We know that the fact that households have built up all these buffers, some people argue allows households to smooth through interest rate increases in a way that they mightn't have done in the past. Because in the last 2 years, in aggregate, households saved an extra $250 billion over and above what they would have normally done in a 2-year period. $250 billion, that's a lot of money. It's not evenly distributed. So that's another thing we're kind of factoring in, kind of the lags, that how are people going to use that extra $250 billion? Are they just going to let it sit there and be part of their accumulated wealth? Or are they going to draw down these buffers? So this is why there's so much uncertainty at the moment, because there's a lot of moving pieces and it's pretty tough.
Okay. Thank you.
Thanks.
Thank
Thanks
you.
very much.